Hi, Adam. Thanks for being here. Could you introduce yourself and your co-speakers?
Yeah, of course. Thank you, John, for having us. My name's Adam Matherly. I'm a partner and corporate attorney here at Holland Knight in our Seattle office, and I'm joined by my colleagues Stephen Clarke and Hannah Aho, also in the Seattle office. And we're hoping to kind of lead a discussion for you around the topic of equity compensation. Um, to give you a little information just on our firm, Holland and Knight's a large national firm with 36 offices, full service firm, large corporate practice. We just helped establish their most recent office here in Seattle just last April. So we're less than 12 months in to our journey here. But they have a great corporate group, great startup group as we go through this conversation, we invite you either during or after this conversation to reach out to any of us. If you're thinking of forming a company, investing in a company, buying, selling a company, or just have general questions that require an attorney, um, we'd we'd love if you reached out to us. So with that, we do have some slides. It's a minimalistic slide deck really to prompt our discussion today. So let me uh, let me do a few button presses here. Okay. I think that's the right combination of presses for you guys just to be seeing slides and not notes
Yep.
from us. All right. Um, this is the title. This is us. We've been introduced, and you'll get to know Stephen and Hannah more as we continue the conversation. This is kind of how we'd like to lead the discussion today. I'll start with some opening comments on just why we're here, and the very basics of what is equity compensation. We plan to do kind of a light overview of founder equity issuances and the types of equity compensation that are awarded and issued to employees and other types of service providers like advisors, directors, etc. Um, but really the heart of the discussion is kind of practical advice, key considerations in the arena of granting equity, best practices, and maybe the funnest part for us, which is the common mistakes and how we coach our clients and other folks to avoid the mistakes we've seen in our practice. And then I put a Q&A session. Certainly we'll open it up at the end, but I we're nimble enough that if you have questions that you want to throw into the chat, or poke John, we're happy to be interrupted. Again, this is fairly informal and discussion driven. Okay. So I'll start just by stating something that I think everybody in the room already knows, having kind of you given me your brief bios. But equity compensation, we're referring to kind of any form of compensation of employees that's um, not just cash, but a share an issuance of securities of the company, which gives them kind of a right to share in the upside of the business, to share in the profits and losses, and then sometimes the actual kind of management and control of the company. And so, what are we talking about? We're talking about things that you've heard of before. We're talking about stock options, various forms of other equity compensation, like restricted stock awards, restricted stock units, RSUs, um, phantom stock, etc. And again, we'll go over some of those types in our overview and just hit on the basics of each. Um, but why are startups using equity is a tool for attracting and retaining talent? I think many of you know the answer. It is um, startups operate on a thesis that cash is at a premium typically. Most founders are trying to attract talent and keep talent there without having to incur huge payrolls. And one way to do that is to use equity compensation as part of the overall compensation package for employees and other service providers. Um, I think really the other gets to startups as opposed to other types of businesses that are not made to necessarily grow fast and then sell. Startups are, and so there is part of the strategy typically is to reward those who helped get the company to a position of some sort of exit, and not just by means of cash, but um, often the talent that you want to attract, they have options elsewhere. Maybe they have options in big tech or big tech adjacent, which offers maybe a bigger uh, and more knowable paycheck. Um, but but what you offer is huge upside potential. The value of the equity that they might receive in the startup upon the exit of the company may be worth um, many times the salary that they could have earned working in big tech. And so um, th that has become part of kind of the startup parlance and ecosystem, and 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 I'm sure most of you are aware of that. So let's dive in. Um, Stephen, can I kind of hand the mic to you here? I think this is kind of where the discussion begins. Can you lead us a little bit into kind of how we think about initial issuance to founders?
Sure. So, I mean, since they're founders, this is obviously going to be kind of your first equity issuances. So it's kind of how you're going to be divvying up the equity of your company amongst the founders. I mean, that's pretty straightforward in theory, but in practice, it can be a little bit more difficult to figure out. The way that we usually try to think about it is both rearward facing and forward facing. So when trying to figure out kind of how much you're going to be allocating to each of your founders, assuming there's multiple of you, is kind of considering what you're contributing to the startup up front. So whether, somebody was kind of the brainchild of your core potential product or core what you're going to be bringing to market, and also kind of taking into consideration what folks are going to be doing moving forward. So, for example, if somebody came up with the core idea, but they're going to have kind of a passive role or maybe a part-time role going forward, kind of a consultant, that person might actually end up with less equity up front than the typical founder CEO that's going to be doing full-time or more work for the company, just kind of in perpetuity going forward. So kind of trying to balance those considerations of what you're bringing to the table kind of up front, and also kind of what you're going to be bringing to the table going forward is important when trying to figure out how you're going to be divvying up that equity amongst the founders if there's multiple of you. And investing schedules kind of similar when you're talking about who's going to be involved going forward. It's important to make sure that everybody's kind of aligned with their incentives to stick around and kind of see the enterprise succeed going forward. So that might be, a classic 4-year vesting schedule with a 1-year cliff. And then we'll talk about a little bit more about this later on in the presentation, but just making sure that everybody's kind of aligned to stick around. So you don't necessarily want to give somebody a huge slug of the company with no strings attached to that. So they can't just kind of walk away unless, maybe they just contributed the idea and you're trying to get them to kind of leave you alone.
Stephen,
Maybe,
you think I can interrupt
sure.
a couple quick points on both of these? So as far as initial allocation, lots of ways to do this, lots of discussion online and through various channels about how to think about the initial allocation. Um, there is interesting data supporting the fact that dual founder or even multiple founders, they do, even equity splits a disproportionate amount of the time, and kind of how that's viewed by investors. I always like to see when a founding team comes to me, and the percentages that they're kind of presenting showcase kind of a thought process as to how they apportioned the initial equity. And I think investors feel the same way. Um, they see a lot of 50-50 splits when in reality the you know the number of companies where there's actual equal labor, equal contribution to the company is relatively small. And I think some investors, um, and we have some on this call, maybe they can speak to it at some point here. But they view that probably as kind of an unnuanced founder team that's kind of having a hard time making a difficult decision, but important decision. Um, and then on the vesting schedules, I'll just note that a trend we're seeing is obviously gold standard for over a decade, over 2 decades, has been kind of 4-year vesting schedule, 1-year cliff. We're seeing longer vesting schedules as early stage companies are taking longer to exit. And in certain industries, for sure, there's a lot of aerospace and space tech companies here in the Seattle area, for example. Those companies tend to take longer um, to exit. And so, I mean, we're seeing 5 and 6-year vesting schedules more regularly. I just wanted to call that out.
Awesome. Thanks. And then just founder agreements and potential pitfalls. We'll get into those kind of in more detail later on, but really you just want to make sure that everything's papered and documented as early as possible. Because I mean, we've seen it time and time again where there's a handshake deal on the front end, and then you get 6 months, a year down the road, and you go to actually document things, and suddenly that's when people say, well, that was when we thought I was going to be part-time, but I've been full-time more than we thought. And you kind of end up having to renegotiate that initial split. So it's really best once you've kind of come to an agreement to make sure that you have documentation to back that agreement up, because otherwise you're just opening the door to issues later on.
Okay. Are we good on founders, Stephen?
Yeah.
Okay. Let's bring Hannah into it just to kind of go over some of the basic equity compensation types that are often awarded to employees, advisors, directors, other service providers. And I mean, these can go to founders too. Often we see founders get kind of top-up issuances, and many are in this form. So Hannah, could you take us through a couple of these, just the briefest overview here?
Absolutely. So for stock options, you have two types that you can pick from, incentive and non-qualified. As you might guess by the names, incentive does have a little bit of a plus in that it often results in less taxes for the person receiving the option. And for anyone in the room who doesn't know, though I suspect most of you do, an option is just a type of equity grant that gives the optionee the right to purchase options in the future. And so there are some other differences between ISOs and NSOs as well. ISOs you really can only give to your employees versus non-qualified stock options. You have more flexibility to give to consultants and other advisors. And there are differences in holding periods and valuation you can redeem in each year as compared between ISOs and NSOs.
Yeah.
Stephen, do you have more to add about RSAs and RSUs?
Sure. So, I mean, restricted stock awards, typically you're only seeing those go to founders or kind of your first hires, just for tax reasons that we'll get into in a little bit. But these are just straight up stock or units if you have an LLC. But the folks that get these will get a number of shares of the company with all the rights of the shareholder typically. So voting rights, information rights, just kind of everything that goes along with those. And the restricted part of those is kind of what goes along with the vesting. So for a period of time, those shares will vest, and until they vest, the company will have a right to repurchase those shares, either at the lower of typically nominal value or fair market value at the time. It kind of depends. But restricted stock awards are just a grant of shares of the company. Whereas restricted stock units, and anybody who's worked at kind of the bigger companies, the Amazons, the Microsofts, the Metas, might be familiar with these. They're essentially just a promise to issue you actual shares or potentially cash in the future. So they're kind of the other side of a coin of an option. You're not granted anything at the time other than promise that you will be granted options in the future, kind of rather than a vesting schedule. So it's the opposite. And then profits interests, that's for if you're structured as an LLC, but it's best to just kind of think of those almost as an option just for the different structure. So your you're granted a right to profits over the value of the company when they're granted. So if your company's worth $1 million at the time of the grant, then the employee or your provider kind of gets a right to the profits above that $1 million. So it's essentially an option agreement for an LLC.
Yeah.
And Adam, do you want to talk about the quasi equity?
Yeah, I mean there are other flavors, and these are not technically equity. They're really contractual rights to receive cash upon some triggering event, and so things like phantom stock, change of control, bonus. These are things which often get kind of issued by companies that see kind of an exit on the horizon, and it may be kind of too late for an option to have to kind of to kind of get well into the money before an exit. What can we do to kind of incentivize this late onboarded employee to share in some upside of an exit that we're projecting in the next 12 to 24 months? It might be one of these mechanisms. And I'll just say, like, as a trend, and probably you've observed, the first two on this list are really those that get utilized most by early stage high growth companies. Carta published their 2025 report not long ago, and I think the statistic was something close to 70% of startup companies are issuing some combination of the first two on this list. And I'm surprised that's actually not a bit higher, because most founders end up with restricted stock. So lots of stock options. They're utilized widely. In our practice, we see both types. And I think that's probably good enough for the overview, but we can certainly answer more questions on this. But there's probably 3 or 4 presentations that can be done on this slide alone. Good. Well, we're kind of getting into like the heart of the conversation, and I'll kind of start it with a like a self-directed question about some of the key considerations. Starting with, I think one of the things a company should really be thinking about with respect to equity compensation is what is its at least an initial strategy. And just like with your business strategy, with your product development, I mean, things are going to change and move over the course of your company, but having kind of a working thesis going into when you start issuing equity to employees, service providers, it is a good thing in my view. It's what type of equity am I going to use to attract talent? What types of amounts, and to who? And on that last point, it's really, am I offering equity to anybody who provides any sort of service? Am I providing it to all employees, or am I providing it to kind of a subset, kind of those that I really need to attract to the company? Is it are advisors being paid in equity, or cash? Am I going to try to issue equity to consultants to kind of offset maybe some of the fees that they would otherwise charge me? So I think kind of having that strategy in mind is useful as an exercise. And then second, kind of determining the initial size of an equity pool. And so for those that have gone through the process, that you don't just speak it into existence in order to kind of issue equity in compliance with security laws. You're adopting an equity incentive plan. You are actually going and having that plan adopted and approved by the board and the stockholders of the company as they exist at that time, and you're announcing how large the initial equity pool will be. And the kind of the rule of thumb has been, kind of, at least in financing context, is this number should be somewhere in the 10 to 20% range, but it really is company specific, and what does your hiring plan require for issuing equity to those candidates that you want to help your company. Stephen, what's the consideration they should be thinking about in terms of this, the third and fourth bullet point, the valuation and the tax implications?
I mean, the valuation kind of comes in down to the tax implications, to be totally honest, and kind of a 409A value. I'm sure you're all mostly familiar, but a 409A valuation is a third party that comes in and values your shares. They give you a price per share, and that's what you're going to set your either exercise price at for any options that you issue, or kind of the price per share for any restricted stock that you issue. And it kind of lets you punt the issue of valuing your company to a professional third party. Because if you are valuing your own stock and the IRS audits you, which it's rare, but it does happen, you need to be able to kind of show your math for how you landed on the price that you landed on, which is difficult. And I mean, nobody's really in the business of valuing their own company. So it's just easier to kind of engage a third party to do that. And the other advantage is it's a safe harbor. So if the IRS does kind of challenge you and say, hey, what's your backup for valuing your shares at this price? You can say, well, we got this 409A valuation from a proper third party and we relied on it. And that's kind of the end of the discussion there. So this is what's going to kind of dictate the value of the shares, the options that you issued.
So let's back up a little bit. Almost all of the companies that are here are pre-seed, haven't taken anything, probably means they don't have any revenue. A 409A for people with nothing but a couple of guys, a dog, and an idea doesn't work. It's expensive and it doesn't give you a number that's meaningful. So put it into context for early pre-seed startups. What are we doing for valuation when we're issuing stocks to new employees?
Adam, do you want to take that or do you want me to?
Yeah. I mean, first, I'll say that the entryway to getting a third party 409A valuation report has dropped drastically. There's lots of services now that will do this for a couple of $100. Whereas the standard 409A from kind of a named valuation firm was doing this more kind of starting point of 3,500, 4,000 up to $6,000, which really is kind of more of a barrier. But your Cartas and AngelLists and things will perform a 409A now relatively cheaply, and they're okay. They're okay. You kind of get what you pay for. Usually, when you're a company soliciting a 409A report, what you're trying to arrive at is the lowest defensible fair market value, so that the company can issue equity at kind of the lowest defensible strike price for an option, for example. The idea being you want to kind of give your employees and service providers the most potential upside on the award. And some of these more automated online services, for example, they're able to charge you cheaply because they're using a fairly automated process and taking more conservative, i.e., kind of higher value estimates. So I always coach people. I mean, if you're going to use Carta or some other online competitor, you're probably going to get a slightly higher 409A, and that's been my observation.
Cool.
Did I sidestep the actual question, John?
In a way.
Yeah.
But the other piece is that Gust, which is the platform we're using for the Seattle Angel Conference, has a Gust equity calculator tool that pretends to have an answer. And so the real notion in my mind is there's a lot of slop in the middle of it when you have no numbers to work against.
Definitely. Yeah.
Yeah.
And I mean, I think that may work in your favor. In my 15 years of assisting startup companies over my legal career, I've never encountered an instance where one of my clients was in an audit situation where it needed to defend its kind of self-determined valuation.
Mhm.
I've encountered one where a client founder did have to point to and kind of dig up an old kind of independent 409A report because they were kind of personally being audited. Um, so I mean, you can tell like this isn't happening a lot. It is something that should be done. It's something that your investors will expect that you have paid attention to. So um, yeah, I self-determined valuations kind of drive me nuts because they always direct those questions to us, and we're just like I try to point people towards some online resources. I didn't know about the Gus tool. Um, is it terrible?
No, it's reasonable. I mean, it's not great because you don't have lots of great numbers to work with, but it's reasonable.
Yeah. Yeah. I mean, it's almost as good as anything I've probably heard, um, you know, our client founders
They
come
have
up with.
two calculations that I think are useful. One is calculating your valuation. The other is calculating, given your current stage, how much should you raise? I think
Hmm.
those are, giving you a ballpark place to think about it rather than randomly picking, all the valuations in the Bay Area are 10 million. So we'll do a safe with the 10 million valuation and
Yeah.
be done, right?
Yeah. Make sure to add the Bay Area premium
Hmm.
onto that. Yeah. So I think have we mostly Stephen, was there something on the last point? I know it's kind of a holistic point, valuation and tax. I mean, really drives a lot of equity compensation, the type that can be awarded. Um, for
So, so one
Yeah,
of
I
the
could.
one of the problems is I hire this new guy.
Mhm.
I tell him I'm going to give him 50,000 shares. Now that 50,000 shares has a value of some kind, and I just forced him to spend a bunch of money. Or the other way around, I give him stock options, but I don't set the price. And so in order to execute the stock options, I end up having to pay taxes on the money that comes from me spending money to get tax options from the company. So can you talk through that process a little bit of where that gets you in trouble?
Yeah. Yeah, I mean, first, I mean, probably on our common pitfalls. I mean, don't make as a founder, don't make blind kind of, hey, we're gonna grant you X without kind of thinking through it first. But if it's framed as kind of we want to give employee something that kind of represents 2% of the company today. Let's go calculate how many shares that would be. Okay, it turns out it's something like 50,000. Can we like in a tax efficient way put 50,000 shares into their hands today? Let's assume we would even want to. Let's assume that we want to add a stockholder to the cap table that this brand new employee should have kind of restricted stock from day one. Maybe if they're going to be a senior person, a C-suite officer or some critical hire, that's okay in our book. But if those 50,000 shares have kind of a fair market value as determined by, one of these valuation reports or kind of a self-assessed valuation process, um, let's say these shares actually have a value in the six figures. Let's say it's $100,000. Um, I assume you're not going to make this employee pay $100,000 in cash to receive those shares. I mean, the idea is that it's a part of their compensation. Um, so what happens when you go and issue 50,000 shares worth 100 grand to this employee? They're going to recognize $100,000 in wage income. And one of the points, if it's not on the slides, I mean, we should definitely touch on it. But like anytime you're issuing equity compensation, be thinking that there could be a wage component to this that needs to run through a payroll process. That's an often missed um, nuance because if you're issuing restricted stock, for example, you're actually required to run the compensation portion, the 100 grand in our example, through um, through payroll, and it's subject to taxes and withholdings, et cetera. And so you can tell kind of immediately it stops being efficient at a certain point to just issue outright stock. And so what are the other ways we can get something that isn't an immediate tax problem for the recipient, um, but lets them share in the upside? And that's why we so often fall back to stock options, because it's tax free upon grant. The recipient can receive the option tax free. Um, Assuming kind of shares subject to the option are vesting over time, they can make a decision to exercise and purchase shares, or they can choose to sit on the option, which is a perfectly valid choice, because there's kind of multiple destinations for stock options, and frequently, if someone's holding an option at some sort of exit event, those options will be cashed out more often than not. Um, the alternative would be that they're replaced by kind of options of the acquiring entity. So I've probably broadened the question like very well in scope, but I think that's part of the tax story, and why so often like restricted stock may make sense early on, where you have a fairly low valuation, but eventually it stops being feasible. Um, and you're needing to find a way to get equity to people tax free.
So I'm sorry, but I'm confused. What is that mechanism for getting equity to people at a low tax consequence? So I have two guys. We get to the point where we have flow. We hire our first technical genius to do the next round of the product. We want to give them 2% of the company. What do we do?
Probably it's going to be tax inefficient to outright give them shares equal to 2% on a fully diluted basis for the C prior conversation. So why not a stock option to purchase shares equal to 2% of the company? The corporation can issue that option. The issuance of the option doesn't trigger a tax consequence for the recipient. If they choose to exercise the option, um, then there's tax consequences, regardless of what option type it is. We can get into that a bit more, but
And so David asks in the chat um, that he's wondering about how this fits into the QSBS Rule 1202
yeah,
process. So if you give people stock options, that's not stock. And then that means that QSBS doesn't work for them, right? Where QSBS would be working for the founders if they have stock.
yeah, that's an interesting point. And it's true. Issuance of the option, just you holding the option, isn't kind of ticking any QSBS clock. You don't hold qualified small business stock while you hold just the option. You got to go and exercise the shares and hold the shares for the sufficient hold, for the required holding period. So one strategy we do see, frequently, is employees who can afford to do it are kind of regularly, once a year, or even, God forbid, like each time there's a vesting event, they're going in and exercising the shares that become vested in order to start the QSBS holding period for those shares. And again, this is relatively inexpensive early on when the valuation is low, to exercise these options. It obviously becomes harder and more expensive as time goes on, and the stock price becomes greater. At which point you tend to see people holding on to their options until some exit.
Can you talk a little bit about what QSBS is?
Yeah, yeah. QSBS, qualified small business stock, is the um, it's part of the tax code. It's a huge tax incentive for founders and investors in startup companies. If you meet the requirements, which is generally holding actual stock of a company that meets the requirements. It's a qualified small business. There's certain small business types which don't qualify. It's under, a certain dollar amount of kind of gross assets. It's got to be a C corporation, for example. There's a list, and Stephen and I we give that presentation a couple times a year. Um, then then the incentive is upon sale of your shares, you can exempt a certain portion of the gain from taxation. And it used to be $10 million or 10 times your basis, so what you paid for the stock. And now it's increased with the big beautiful bill. There was a number of enhancements to it to make it even more attractive. Um, the total amount went up to 15 that could be exempted, and that's going to be adjusted for inflation. Um, and what else? What am I forgetting, John? There was more attractors they put on it.
Um, the hold period, I thought it was 5 years. David is saying 10 years. I
No,
think it's
not.
5 years.
Yep, it's 5.
Uh, and you get the stock, you hold it as stock. There's a bit of conversation here about safe, whether a safe starts the clock or not. And that's an issue. And you hold that company stock for a company that's less than 50 million for 5 years. And then you have essentially the first 10 or 15 million of whatever capital gains comes back, you get at 0% tax. That's my understanding.
Yeah,
And
yeah,
and
it,
all of the other things are, is it really a growth business that we want to support or not? And
yeah,
most of the things we're talking about here are growth business.
yeah. So this whole topic, it's relevant to the equity compensation discussion because for something like stock options, especially if you're a recipient of options, like there should be probably some calculus as to, do I want to exercise some shares here to start a holding period, or am I gonna hold the option? Um, but certainly for founders, I mean, like 10 out of 10 founders are receiving outright stock, at least at the initial kind of organization of the company. And for any kind of traditional startup C corporation, that's intended to meet the requirements of qualified small business stock. Again, provided it's an actual kind of business type that can um, that can issue it.
So I'm believing that Rule 701, which supports the distribution of stocks to uh, incentivize employees or consultants or landlords or whatever, um, also then triggers the opportunity, since you're getting stock, to use QSBS. Is that correct?
I might need you to run that one by me again.
So I have a consultant. He works for me for 6 months. Half of it I'm paying him minimum wage. The other half I'm giving him, stocks as a result, using Rule 701 as the exemption to pass the stocks to him.
Okay.
And now that he has stocks and he holds them for 5 years, QSBS works. That's how I believe it works.
Yeah, I mean, unless you left a trap in there for me, I mean, yeah,
Yeah,
we'd run the checklist and make sure you're a qualified small business, that you're not, exceeding the gross assets threshold, et cetera. But
right.
yeah, nothing you told me there scares me from a conclusion that's qualified small business stock.
And so that's the difference between, 24% tax and a 0% tax, and that gets to be big money after a while.
Yeah. Yeah, I mean, the investors on this call will tell you, I mean, they're high on their list of looking at companies is seeing if it has the ability to issue qualified small business stock. Um, and I mean, it's a deal breaker for many kind of VCs, where it's just part of their investment thesis that they're only going to invest in companies that can issue it. And
Right.
again, at least at the early stage, there comes a time where you're late stage enough that you're not going to meet the gross assets threshold anymore, and you're not going to have the ability to issue it,
Right.
which doesn't take
So
away the benefit from the earlier the earlier issued stuff, right?
Let me turn this a little bit to the side. When I was at Hewlett Packard, we got profit sharing every month or every quarter, I don't remember. And that would come in the form of stock, right? They would issue stock to us and they would pay the taxes on the stock that they gave us. And that was reasonable because it was public stock. Is it reasonable to give people not public stock, private stock in that same manner?
Stephen, do you want to opine? I don't want to hog the airway here.
No, sure. I mean, I personally haven't seen anybody give stock as kind of a bonus. I mean, it could be done theoretically, but I mean, early on, not typically, no. Because I mean, the entire point of early issuance of equity is kind of the long-term upside. So theoretically, you grant it to people, but I mean, that's going to come, like Adam mentioned, a lot of the time with kind of a tax burden. Whereas with public company stock, you could turn around and sell it the next day and kind of get the cash that you want, or you could choose to hold it. Whereas you're almost putting the onus on the service provider to just pay a tax bill for future upside that they didn't necessarily ask for.
Yeah.
Well, as I said, the company, when it distributed stock, also paid taxes. So there wasn't any consequence to the employee at that point or the service provider. But the underlying point is that it's certainly illiquid, but it gets you out of some of the questions around do I make an election? Do I have to, pay one thing or another? It's just plain profit sharing in one way or another. I'm basically paying out of my revenues to benefit the people who are benefiting me, kind of thing.
Yeah.
I haven't seen much of that personally, and I mean the entire point of a lot of startups is that they aren't profitable, so there aren't really many profits to be sharing early on because you're investing everything just in the growth of the company. But
Yep.
I mean, there's nothing stopping you from giving top up grants to folks as they kind of show loyalty or stick around. I think that's the more common thing is,
That's
hey,
right.
you got this initial grant when you came on, you've been here for 2 years, you've done good work. Here's another tranche of options or something to reflect what you've done. But
Yeah.
I don't think I've ever seen it as kind of a bonus plan necessarily.
Yeah. David is saying he's seen a stock grant to the employee for like 30K of value and then to give the employee a bonus of 7K to cover the taxes in the granted stock.
Yeah. We see things like that from time to time. I more often see the kind of company contributing cash to for a key hire, for example, so that they can exercise options early. As an example, there's some creative things that can be done. I don't personally work with any clients who kind of regularly issue cash alongside options for the purpose of exercise. So, but I've seen it before. What do you mind, John? Maybe we can dive into a few kind of best practices again, just to kind of
Yep.
continue the
Yep.
conversation in other directions. Hannah, do you want to kind of tell us what we consider best practices on communicating and documenting?
Yeah, so there's a three-step process to making these equity grants, and it's important to follow them just to make sure that if things come up later down the road regarding the grants, you've done the right steps and you've protected yourself. So your first step should always be making sure that you have, if it's an employee, an offer letter or some sort of letter, if it's an advisor or consultant, that clearly lays out what type of equity grant they're going to get, whether that be an option, restricted stock award, something like that, and the number of shares they're going to get. We always advise against doing a percentage because it can cause a mess a little bit later down the road when you're trying to figure out say if you give someone 2%, what 2% means changes over time. So it's better to just put a number on it from the get-go so everyone's super clear on what's going to happen. Once that offer letter or other similar letter is signed, you'll then go to your board or your management committee or whatever sort of top structure you have in your entity, and you'll get that grant approved. We always recommend doing that in a written document so you can refer back to it later and have it shown that everyone who's supposed to approve that grant did do so. And then once you have the proper approvals completed, it's time to draft your actual equity award, which is something your lawyer can do for you. And that will lay out all of the specifics regarding that award, including vesting schedule, any restrictions on the stock or the option, and things like that. And then keeping all of those documents in your records for later on down the road. 9 times out of 10, you don't have to use them again, but it's always good to have them.
That's perfect.
Yeah. Yeah. Hey, that percentage one is like such a typical, it's probably on the kind of common pitfalls slide as well. Um, where a founder will throw a percentage into the offer letter. You'll receive equity equal to kind of 2% of the shares of the company. But what ends up happening because of this kind of three-part process, there's communicating kind of the promise of the award, there's going and getting it approved, and then there's going and actually creating the documents and getting the documents signed to issue it. Because there can be a lag between these steps. I mean, it's not uncommon for companies that are doing a lot of hiring to they have a bunch of offer letters flying around. But they're not approving new stock options every day. Their board isn't. Instead, they're kind of batching all the options that were promised for the last month or even couple months in some cases and going and approving those at the same time. And so what was 2% when you wrote it down in the offer letter may not be 2% at the time that this award gets approved or issued. Um, maybe there's been some financing activity since then. Maybe there's been um, an increase to the size of the option pool. And any number of things can happen that can kind of change the cap table in a way where 2% is not 2% anymore. So anyway, Stephen, what about the kind of best practices on the vesting and acceleration?
Yeah, so like Adam's mentioned a couple of times, you should adopt at some point, probably after your kind of initial slate of founders, a stock incentive plan or an equity incentive plan. There's a bunch of different forms; they're all functionally the same, but that's kind of govern your equity grants to your service providers and your kind of third party independent contractors potentially. Um, that'll kind of have the standard terms. So how many shares you reserved to issue to service providers? It's going to have kind of your standard acceleration on change of control, kind of restrictions on transfer. They're long documents, but they're fairly standard. And it's you need to have one before you start issuing kind of equity to your service providers. With that kind of comes having a standard vesting schedule for the reasons that Adam's touched on, and kind of managing your equity issuances such that, I mean, for a lot of these pre-seed companies, you really just want a folder of documents that when you look at the cap table and you see an issuance of 2% to, John Seacrest, you can point to those documents that kind of establish that issuance so that potential investors can come in, they can look at your cap table, they can look at your documents and just say, great, these match. I'm not asking questions. There's no uncertainty. So really you just want to make sure that you have that kind of board folder of documents.
Yeah, really well said. How many hours of our lives have the three of us spent trying to track down the components the investor wants to see? They want to see the offer letter. They want to see the board consent that approves it. They want to see the issuance documents, and they want the numbers to be identical.
Yep.
And you can imagine how many times that isn't the case.
Yep.
All right. The last two things I think are kind of grouped. When you start issuing equity compensation, it really is time to start getting serious about your cap table management with, a handful of founders and kind of agreed upon percentages. You're probably able to kind of keep this straight in your head or in a basic Excel file. But now you need a way to track stock options, for example, that have been granted over time, and what are the vesting terms? Is the option, like, are the shares subject to the option even outstanding anymore? Did the person leave and now those shares are canceled? And what happened to those shares? Can we reallocate them back to the option pool so they're available for other issuances? I mean, you can do this in Excel. Some of our clients do that. You can use Carta for this purpose or other online kind of cap table management platforms. But I'd coach, even if you're using one of those systems, if there's somebody internal to the company that's not very good at record keeping, or you're not getting kind of regular oversight from your legal counsel on those systems, like they're basically worthless. Um, Carta is only good as the data that you put into it, and it can be, you can have it clean and pristine when you get it kind of uploaded for the first time. But if you're not regularly maintaining it and having it kind of overseeing and updating the stock options as people come and go, um, it doesn't give you a good current picture. You're not using it for the purpose it was intended, which is like to convey these equity holders what they actually hold. Um, have I harped on that enough? Yeah.
Yep.
All right.
And I think just talking about Carta, there's some conversation in the chat. They do have kind of a launch stage where it's free for companies that have raised less than $1 million and have less than 25 stockholders. So most,
Yeah.
if not all, pre-seed companies.
Yeah.
Um,
Yeah,
and
that's attractive. A lot of our clients, we point them to that solution. And we also kind of raise our hand to, if not have our kind of hands on the control. I mean, our preference really is we're kind of doing the inputs, but if we understand we're not free, and so if not that kind of periodic audits of the inputs.
mhm. But Carta, I think, makes the most sense for kind of the post seed once you kind of have a complicated enough cap table that it's worth investing into.
Yeah. Yeah. Um, Stephen, what about so we're kind of we've done key considerations, some best practices. What about common mistakes as far as over granting or under granting? How do you think about this? How are you coaching our clients?
Over granting, I mean, they're both kind of exactly what they sound like, but just kind of with different issues. I mean,
Yep.
over granting, once you've issued something to somebody, it's really hard to take it back without their consent, especially. And a lot of the times when you are trying to take it back, it's because there's been a falling out. You've realized that the co-founder that you issued a third of the company to hasn't done anything in 2 years, and it's not really fair for them to hold on to that. Or your vision doesn't align. So kind of doing what we talked about and having a thoughtful method for kind of allocating those initial kind of slices of the equity can go a long ways towards solving for this. And if you do overgrant, there are solutions. It just usually requires more negotiation than founders want to be doing at that stage.
Yeah.
Undergranting is
Can I say, not to interrupt you,
no,
but
of
to that
course.
point,
Yeah,
we kind of talked about kind of creating a strategic plan for equity compensation. And part of this is certainly looking at your pool, and you should be thinking about this before you even kind of determine what your pool size is. But thinking about your hires over the next, 12, 18, 24 months, and thinking about how much equity it's going to take to attract the key hires for the company, including kind of earmarking a certain portion for advisors. Depending on what stage you are, maybe some for independent directors, which are often awarded, stock options, for example. Um, and really kind of having a roadmap so that you're not just pulling numbers out of thin air when you get an attractive, CTO candidate, for example. And I'll also say we could have done a slide on this, but you can ask any of your chat bots. Even Google probably does an admirable job, but like lots of information out there is kind of the typical ranges of equity that different positions receive at different stages of a company. Um, the cash compensation that's being paid to startup employees right now is trending up. Startup companies are having to pay more cash, but the equity compensation, these ranges for different positions, has really kind of remained almost exactly the same over the course of my career. And so go look up those tables and print a copy and kind of have it as just like a rule of thumb. And those rules of thumb can always be broken for the right type of candidate, but you should have kind of an idea of what's normal.
awesome. And then undergranting equity, it's more of an administrative issue. There are solutions, but it's just kind of a problem that can be avoided with forethought. Where, if you hired on somebody as a lead developer, say, and then later on you want to bring them on as a CTO, and you want to grant them another 10 or 15% of the company, but the company's already worth 2-3 million in the pre-stage round. You don't really want to be triggering $100,000 of tax bills for the guy that you want to be kind of helping lead your company. So to avoid that, just kind of the forethought that I mentioned, and there are solutions to that kind of thing. I mean, there's some methods where you can lend them the money to then exercise their options so they don't incur taxes. Then that kind of debt stays outstanding until there's an exit. I mean, there's a bunch of kind of complicated ways that you can solve this, but those complicated ways come with legal fees and time that you don't want to be spending when you're building your company, and just issues that can be avoided with a little bit of thought to begin with. So undergranting equity can be just as big of an issue, but for almost more annoying reasons, because you're just trying to do somebody a solid to fix it up later, and it's taking up all your brain power and your legal fees. Adam, do you have anything else? Hannah?
No, no. We've kind of discussed some of these points in the other sections. I did want to touch on the fourth, which is a kind of a common mistake that I see founders make, which is they're talking with a candidate and negotiating the equity compensation, and the founder is tempted to talk about the equity compensation in terms of a dollar value today. And I think, like, with some caveats, I think you can kind of do this if you're describing it well. Um, but for example, I was talking with a founder recently who's kind of trying to convey, you're getting X dollars, per year in base salary plus options worth $30,000 to kind of get you kind of close to what your compensation would be on the open market. And the problem with that, of course, is like the options are not worth $30,000 when they're issued. Um, if they were, we'd have we'd have tax problems that we were trying to avoid. No, they're worth $0. I think, probably what founder is trying to say is, we toggled the number of shares for this option such that you're going to get X% of the company, and based on our kind of valuation right now of the company, that's worth $30,000 today. Now, if you care to explain all of that, maybe you can have that conversation, and say that's what I mean by $30,000. But that's often not how founders are saying it. They're saying it as, okay, let's go calculate $50,000 worth of options, and it's just not accurate. It's confusing, um, and maybe underselling, because hopefully, like, the options in a good exit scenario are worth much more. So I would kind of say, pitch the promise, pitch what they could be in terms of potential dollar value, because we know these options, when they're issued, are going to be worth zero. Okay. Let's see. Stephen, Hannah, you have anything else on uncommon mistakes?
The only one that comes to mind that I don't think we've touched on is 83B elections.
Yeah.
So if you're issuing restricted stock generally, then pretty much everybody that gets those should be filing 83B elections. And that's basically just agreeing to pay tax on the grant of the stock at the time of grant rather than in the future. And if you don't file an 83B election, then every vesting event of those restricted shares is subject to taxes. So if you issue founder stock for a fraction of a penny on day one, and then that's still vesting 3 years later when maybe you're worth 20, $30 million, that could come with pretty significant tax bills for the founder, and also pretty significant payroll tax bills for the company as well. And it's a typical overlook for companies where, somebody missed an 83B election, and they haven't been recognizing payroll tax or withholding payroll tax on those vesting events, years later. So making sure that those 83B elections are tied up, especially for founder issuances, is very important, both for the founders and for the company.
So the important thing to mention here is the very sharp and bloody edge of the 83B election, where you only get the chance to do it once, and it has to happen within a time box. Can you explain that?
Yep. So an 83B election is one of the few hard deadlines that you'll have in these things. And you have to file the 83B election within 30 days of grant. And if you don't, then that door's closed and that ship sailed, and you just don't get the benefit of that election. And both you and the company kind of has to live with the consequences of that going forward. And And that can be an issue both for you and the company, and also investors can take issue with that as well. One of their diligence points in earlier rounds, one of the few diligence points really, is whether or not founders or early recipients of restricted stock filed these 83B elections.
Yeah. It shouldn't be a mystery either to the company that issued. It's the company must know whether you filed the 83B in order to run the payroll correctly. Because if you filed it, you're going to recognize the entire fair market value of the award kind of today in the current tax year. Whereas if you don't make the election, we've got to kind of assess compensation over time as it vests, which is trickier. And certainly we've been in positions where the parties didn't talk, the recipient um, didn't file an 83B, but the company thought it did, and vice versa. And so the tax, now somebody's got to go amend their tax returns, or both parties. I'm in the middle of one of those now, and these are expensive problems to untangle, unfortunately. Let's see.
That was the only other one that I thought was worth flagging.
Yeah, well, that's good. Well, I think we'd really like to throw it to Q&A if there's like specific topics on people's mind at this point.
Well, let's go to a group view then. Why don't you lower the screen or the slides, and then we'll see who has questions. Who has questions about compensation? Joe? You're the first one I picked on before. No?
I think he asked in the chat how to allocate shares for founders, investors, and employee options with an eye towards kind of mitigating dilution in subsequent funding rounds.
Yep.
I apologize. I was a little bit late. Is this more of a legal, or is there CPA here too? Because I have a question.
We're not CPAs, but we get thrown a lot of tax questions. We're dangerous enough to pretend. So you can try us.
So we just converted to a C corp. We were an LLC and converted to a Delaware C corp. And so I had a lot of negative equity. And so how does that work if in terms of a tax obligation?
A lot of negative equity, and that you had prior business losses.
Yeah.
I mean, that's a common pathway. It used to have a name for that, the vampire method of startups, where an individual or a couple founders would go form an LLC and take losses for the first couple of years, and then convert to a C corp. It is outside my wheelhouse, the exact tax consequences of that, except that I don't think it's severe. There are certain types of conversions which you really have to like be very strategic about. But those are the LLC kind of taxed as a partnership, converting to a C corp is such a well-worn road, and especially those that have prior losses, that definitely talk with your accountants. But
okay.
I bet you it's not insurmountable.
So on a lot of the companies that we see coming into SAC, they're C corps, but they recognize a lot of that founder value as loans to the company. And then as investors, we ask them to convert those loans into stock so that it's not I have all this money sitting on the books that's supposed to get paid back to the owners of the company because they got an angel round, right? We don't want to fund previous development with our angel investment. And is there a way to recognize that set of losses as stock at some kind of transaction?
Well, you're saying losses. Do you mean the loans?
Well, he spent a bunch of money. Let's say he spent $2 million to get the thing up, and the way that he's recognizing it is as negative equity, right? As losses. So then, now that it's a C corp, where did those losses go?
Yeah, So I think you already received the benefit of the losses via your personal returns. Like I don't think you can now say, hey, let's recharacterize these losses as loans and then go kind of convert them to equity at the C Corp level. I haven't witnessed that. And I don't know if that's what you're asking, John, but that's kind of what it sounded like
Well,
the question was.
presumably, if you had kept the record straight, I'm taking money from my personal pile and putting them into the LLC pile, and now that's founder contribution, and that founder contribution then should translate in some way to shares if you kept the record straight.
I mean, I think probably the more straightforward example is the founder who originally formed a C Corp and is dumping a bunch of money on it and is characterizing those as loans. Um, like certainly we see numerous treatments for that, converts to converts to shares, or it's carried on as loans, or it's just additional paid in capital, which kind of enhances the tax basis to the shares they already have. Those are the three
Mhm.
options in those scenarios. And it's a good question, and it often goes kind of underlooked because, I mean, I'm sure of all the startup companies represented here, most of these are self-financed in some respect, and you're keeping track, hopefully, of how much money you're personally putting into these companies, so that you can make a decision at some point. And maybe some of you have already decided, like, what is what is that dollar amount? I've put $50,000 into this company. What actually is that on the balance sheet? Is it a loan? Is it basically my contribution for the ownership of the company? Um, or is it something else? And the third is kind of a magic trick. It's just additional paid in shareholder capital.
Yeah. Robert asks if there's a good place to look up common compensation amounts. And I think you said earlier the ChatGPT and various AIs are the right place, but is there a better place than that that's more definitive and less
So
hallucination? Tilting my
I,
head towards Richard.
if you know, John, let me know. I mean, these scrape kind of well-known databases. I haven't seen hallucinations. I ran kind of relatively the same prompt over over ChatGPT and Perplexity and some other platforms that I've used, and they're able to produce basically the same exact table. And the prompt is just something like, "Can you create me a table that shows kind of the typical equity compensation by percentage for various roles in the company for different stages of the company?" And they're usually smart enough. And I've compared them kind of side by side, and they're arriving um, at the same, the same ranges. Like,
So
yeah, yeah.
Joe had a question that I'm not sure that we quite got to what he wanted. So Joe, you want to lean into that question a little bit more?
Yeah, I was just wondering if you could provide like some guidance or best practices for kind of what percentages you should allocate for the founders, early investors, and the employee stock pool, with an eye towards, hey, in subsequent rounds, how do you ensure that, yeah, the early investors are sufficiently compensated, that, the dilution isn't going to have a severely negative impact on the early employees, and that the founders will still be able to maintain a decent amount of control over the company.
Yeah. Yeah, it's a deep question because it veers into financing strategy. But the equity, I would say, kind of the pieces we talked about today, the whole pie, the whole cap table initially is just founder team, and that could be what one person, or it could be it's you found a co-founder from the outset. But initially the entire pie is just kind of the founders. And then at some point, there's a recognition that in order to retain kind of the non-founder service providers, which I use to include employees, consultants, advisors, et cetera, we should establish some at least initial fixed percentage, which we're going to reserve for issuance to those folks. And that range varies pretty widely, but I mean, I think five, like just to not like 5 to 30%, I think is kind of like the typical ballpark, which is a pretty broad range. And more typically, it's kind of in the, I would say 5 to 15 um, percent is where these tend to fall like initially. We should have put in pitfalls. I mean, a big error is making the option pool too big too fast, because who's getting diluted by you guys reserving, um, you know, 30% now? You guys are taking yourselves, the founding team, you're taking all of the dilutive hit of establishing that reserve pool.
So I don't quite understand that statement. So I'd like to sort of play my naive narrative, right? I I know that I'm going to do, at least 4 rounds of funding. I'm trying to get to a $250 million company. I figured out, here's what the founders are putting in. Here's what I'm going to look for from friends and family. This is what I'm going to look for pre-seed, seed, and Series A and my Series B. Why don't I just allocate all those out into chunks and just leave them deployed, right? So they're allocated, but they're not deployed. So in the beginning, I'm only in the first one, but all the rest of it's defined. And I just allocate out of the correct pile as I move along. And now I know exactly what I expect my math to be because I've predefined the math, right? Why wouldn't I not do that? And I think that's what Joe is asking for, right? I
Yeah.
want to know what my things are, and I'm not having any surprises where I believe that I have a certain amount of the pie when, in fact, I've already in my mind allocated it. I just didn't write it down.
Yeah. I, you you could do this. And I'm not recommending you do, but as like a mental and planning exercise, what you're talking about is actually fairly useful. Going and kind of figuring out where you want to be, 2 raises ahead. That's how we coach our startup clients, is to be thinking 2 financings ahead, and we help our clients kind of model out, um, if you're at kind of seed stage, and you're thinking about starting to negotiate your Series A term sheet. We're not just thinking about the Series A terms that we're how much of the company we're going to be giving up in the Series A. We're thinking about what is going to be the next financing as well. Because part of the pitch of the Series A is we're going to take this money and get to Series B. Um,
Right.
so it really is, you need to be thinking down the road like you are, Joe, as to kind of what you're allocating for each round. But in truth, I mean, like, you're in order for those values to hold true, like all of your investors are going to need to agree 100% with these allocations that you've devised from the outset, and the likelihood of that is relatively small. I mean, that would be a wonderful world, right? Um, but
Well,
Yeah,
in
I'm assuming
in
you
the
can't. Sorry, go ahead.
in the end, the decision on the deal terms and the decision on the allocation and all of that functionally comes down to the CEO. Now, it may be a question of what the market is willing to do, and that's just a question of
yeah,
how much of a market making you have to do to make things go. And VCs nor angels are, none of them are homogenous. And so just because we have one story doesn't mean that's the story that works for everybody. And so it's a matter of finding the right audience. If you're doing a revenue redemption deal term structure, so you don't take, a particular round of funding, that limits which angels are willing to play with you, right? But then that's a CEO decision to make, in my mind.
yeah.
But the problem is that they're typically unaware of their choices, and so they take the generic, vanilla answer from everybody and get a VC answer when that's not the only answer out there.
So
Yeah, I
to
was
sort of
assuming we
press,
couldn't do
yeah,
the like look at it all in advance and know exactly what the things are going to be, but gaming it out a couple of rounds in
yeah,
advance makes sense. But I was just wondering if, like, based on going through that process several times, you listed a option pool range from 5 to 30%. Is that range because you need to start it at 30% so that by the time there's a possible exit, it's down to 5%, and therefore, it's still a good return for those early employees? Or, like, is the pool 5%, and then it might get diluted down to, maybe 0.5%, but the numbers work out that that's still a good return for early employees. I was, trying to see if there were rules of thumb, best practices. I know there's not going to be a definitive answer, but
remember earlier when they said we're going to allocate you 2% of shares, and then they didn't actually define what they meant by shares. You have that
Right.
same problem, 30% of what?
Yeah.
And
Right.
so if you're talking about this particular round at Series A, there's a thing. But if we're talking about 30% at the end when we've done 3 more rounds, that's a different question, right? And so that's why the exercise that Adam identified was important, is to name it at the correct stage. And
Yeah.
again, in my mind, working out in some level of detail makes sense.
Yeah. And remember too, every financing, every preferred stock financing is going to be kind of an opportunity, whether you like it or not, to kind of revisit the size of the option pool, because that's a negotiated point between you and your lead investor. Typically, investor is on the side of negotiating an increase to the option pool that won't dilute that investor, by the way, will dilute the current stockholders, because they think, and they would argue, you're going to need more equity to attract the talent you want to get to the next financing stage.
I hadn't realized that increasing the options pool is a separate class of stock and therefore does not dilute the other.
No,
the
that's
other
not what he
shareholders.
said.
It's not
Oh,
necessarily
okay.
a separate
Okay,
class.
okay.
It's just that they'll say that the shares for that increase, kind of for purposes of calculating kind of the value of the round, will only dilute the current stockholders.
Yeah,
So they're
sorry
saying,
about that.
And not the new
Gotcha.
stockholders.
Yeah.
I see. Okay. If options are just the right to buy a share at a certain price later, why is it necessary to actually have them reserved? If they're not going to be able to exercise it until you go public or there's some kind of acquisition event.
Yeah, that's kind of a philosophical question, because they may choose to exercise, and you need to have the shares available and reserved in order to issue those shares when and if exercised. Does
So
that make sense?
let's assume that I've allocated 100% of my shares, and I have somebody else who's got a stock option, and I can't allocate any of the current shares because we're at the state limitation of what we said we were going to allocate. How hard is it to add more shares at that point?
Yeah. Is that Stephen? Actually, would you like to take that one? It depends on the company.
Yeah.
It's typically not that hard.
it depends on kind of where you're at in your company's stage as well. I mean, it's as simple as amending and restating your certificate of incorporation, either in Delaware or whatever state you're incorporated in. And that kind of gets more complicated kind of as your company moves along, because the people that have to consent to that just becomes a bigger group of people. So initially, it's just the founders that need to, vote to amend your certificate of incorporation. And then once you get into the Series A, Series B, you need the consent of those lead investors or majority holders of those classes as well. So if you want to go increase that amount, you have to go to your lead investors and explain to them why it is that you didn't kind of negotiate this as part of their round, and they have to sign off on it. So it just becomes more of an administrative exercise.
So it's a material action that is reserved for stockholders. It's not delegated to the board to decide.
That's right.
And
that's a big point of kind of negotiation with preferred stock rounds, is those lead investors are going to negotiate for rights over, having consent rights over doing that, because increasing the option pool as a part of the raise won't dilute them, but then if you go increase it afterwards, it will dilute them. So they do have a vested interest in that.
But can it be delegated to the board to make that decision? No, legally it can't be.
Yep. Under Delaware, a lot of stockholders have to approve an amendment of the certificate. And that's where your kind of number of authorized shares lived.
And that's why we don't want lots and lots of names on your cap table.
Yep. But one of the reasons why you also set aside kind of the reserve for your option pool is there's this concept of fully diluted capitalization. And that's kind of so that everybody understands when you say 1% of the company, they're all talking about the same thing. So there might be, 10% of your authorized stock isn't issued yet to employees, but because you have it set aside in your option pool, when you and your investors, you and your founders talk about kind of a fully diluted, percentage of the company, we want to raise or give away 5% of the company for X dollars. Everybody's talking about 5% of the same number and not, a moving target that changes every time you issue options to your latest hire.
Yeah.
Everybody's kind of talking about the same number and the same percentages.
Yeah, we like that. When the denominator stays the same, that's very helpful. The denominator, the fully diluted shares number should really only change upon an increase to the option pool or some financing event. I mean, there's a handful of other things that can do to change it, but typically it says.
Yeah, and it gets a little nuanced because, like you were kind of alluding to, like if there's allocated but not issued shares when there's an exit, I mean, those unissued shares aren't going to get any consideration. So the folks will have kind of two percentages. They'll have their percent of outstanding stock and then their percent of kind of the fully diluted stock that assumes that everything has been issued. So the percent of the issued is kind of what you'll get, subject to a lot of reservations in the event of an exit. And the percent of the fully diluted is what you would get if every single share of stock that's been allocated has been issued.
All right, got it. Thank you.
Yep.
Are there other thoughts or questions that people want to ask? All right, I'm not hearing any. I do know that vesting is personal experience. Vesting is really important, and it's really a pain in the tuchus to allocate a big check to somebody who left 3 months after you hired them, but you had allocated them a certain number of shares. So do think hard about your vesting. We do have a workshop coming up relatively soon on the 17th called Meet the Funders. So you'll be actually able to go and talk to some of these people that do funding and see whether or not they have any thoughts about how things should be set up when they do due diligence. There'll be plenty of breakout rooms. Thank you, Adam and Hannah and Stephen, for being here. Really appreciate you engaging in this question. It's always difficult for us to get all of our heads around all the things that we have to do to make our startups go forward or for us to invest. I will be putting this on the YouTube channel, so the recording will go up there. And if you want to save the chat with all the links that we did, there's 3 dots in the top that you can use to save the links. So thanks very much for coming.
Thanks for having us, John. We really appreciate it.